Traders, how many times have you seen headlines, social media posts, or social media ads which tells you this is how professionals trade? Learn how institutional traders trade or learn from best hedge fund managers. But here's one secret for you. Honestly, in 90% of the time, those institutional traders make money in the ways which are not related in any ways to retail trading because, well, most of their money comes from the market activities which has nothing to do with, so to speak, directional trading, or in other words, they do not trade to anticipate market moves in their direction. They're trading differently. And this is something you should learn and should understand if you are trading and listening someone else's advice, especially about institutional trading. So let me explore you in, I would say, some detail how institutionals actually trade. So first things first, as I told you in introduction, usually they do not take directional trades. Most of the money they are making in trading is done, I would say, as a brokers, but in more advanced way because most of the investment banks are actually working as so-called prime brokers, or in other words, they are brokers for brokers or other institutions such as mutual funds or hedge funds. So when you see those huge trading desks, what they mostly do is they are executing orders on behalf of their customers. So for instance, if you trade your euro against dollar currency pair, luckily, in good case, this trade will go to your broker, and then your broker will execute this trade. But how he will execute this trade? Well, he simply wouldn't go and find seller or buyer of your trade. He will do that by going to investment bank, which will work on behalf of his brokers. So what he probably will do, he will just put himself thousands and thousands of trades and give this to his prime broker, and his prime broker will have dozens of others of brokers which will in turn also will have thousands and thousands of trades, and we will make that huge list of trades and market them with other buyers or sellers from another investment bank. And of course, in today's world it happens electronically, and it will happen just as I snapped my fingers, but that's an idea. This is how they make money, and they are taking their cut for that. So this is one way how they trade. And also, if they have huge quantities of trades, for instance, if someone wants to buy or sell 20 billion worth of bonds, you probably wouldn't do that as same as you did with your euro against dollar trade. So then also, most likely these trade I would say, facilitators will be mutual funds, and they will go to investment banks to facilitate their trade. So investment banks will connect with their customer base or other banks, and they will execute this trade. So this is sort of theoretical explanation how this is done. In practice, well, of course, things might not go that smoothly, and there also are cases when prices are not markets are not executed for the best prices. There might be some conflict of interest, scandals, and whatnot. This is financial markets. What we want to expect here, yes. And in many cases, your broker will actually won't go to investment banker because he will probably trade against you. This is not illegal, but unethical. But this is the broker's trust to the retail traders. They know that retail traders actually trade so bad that it's really profitable to trade against them. So this is the thing to consider for you. But nevertheless, the key bread and butter business for huge institutions is to make money by executing their customers' trade. This is bread and butter. Other stuff is, which is kind of relating to previous one, is market making, or they are providing liquidity of other players. So currency markets is made up by traders, and those trillion-dollar trades are usually facilitated by investment banks, and some of them are responsible for a pretty large chunk of volumes. So they have to take either buy or sell orders regardless of they have immediate buyer or sellers. So in order to make market liquid. So this is other operation that they do. Effectively, what they are doing is they are holding their bid-ask spreads. Now, of course, it goes directly related to previous example, when they are executing their trades on behalf of customers because they are making some price differences and making money. They have to eat as well, right? But still, this is the second thing that they do. They are making sure markets are liquid or doing market making operations. Then we go to third aspect. And third aspect is more, I would say, not investment banking, but hedge fund orientated, or in other words, it's more now going closer to the trading, and this is arbitrage and algorithmic trading. Here, here money is made on market inefficiencies, or in other words, advanced players with huge sums of capital have advantage to make money first, or make money for slightly better prices. The parallel, I would say, could go with the physical trading, when you would see that if you are executing your trades with your broker goes to trading floor, and in the trading floor your order is filled. And those people who are standing on the floor, they usually have, not usually, they always have better knowledge of direct buyers and sellers and slight information and price edge. And this is why they are standing at that trading floor, because they have legal price and information edge. And nowadays, this is done with technology. So largest brokers and not brokers, but largest hedge funds and investment banks have the same opportunity as well. They simply have algorithms how to trade the same news. You are trading much faster and much smoother. So this is another way. This another approach of algorithmic trading would be to use arbitrage in its favor, or in other words, you simply buy or and sell same security, whether this is from different exchanges, if commodity or stock is traded on direct exchanges. Excuse me, if commodity or stock is traded on different exchanges, or if you are using futures or options contracts. If in one futures date there is huge price difference, then in other futures date you could buy and sell this simultaneously, and this making thus making money on these price inefficiencies. Well, you have to be real specialist of that market, and you have to understand those patterns and tendencies real well, because this is not something that you could be doing without understanding why these price differences are, because futures contango and backwardations happens all the time, and you are not only one who is making money on these differences. But if you know this market well that you want to trade, for instance, you are specialist in the grain market, you could know there could be anomalies due to some huge price spikes in either direction, and that could provide you with good ways to make money, or to lose it if you don't use risk management correctly, because there have been many instances when huge hedge funds have made spectacular losses in span of 1 or 2 days, because they didn't know how to manage these price issues correctly with arbitrage. So nevertheless, this is the way how institutions make money, not on direction of the trades, but on price mismatches. So these are three ways I would say 90% of institutions make money. And out of these three ways, there is no way as a retail trader that you could learn from that. But there is one way you can, because there is trading approach which is called global macro trading, and which is historically has been one of the profitable ways how you can trade on markets. And I would say it has been producing plenty of extremely rich and extremely successful traders. And luckily for you, day trading approach is relatable and applicable to you, because they are making money on market trends. If now we are looking at something, we have silver now, yes. If we are looking at silver, you could see that silver is commodity which is traded on futures contracts. So it's difficult for us to arbitrage or make something out of price efficiencies if we have retail account. We cannot give market making opportunities for silver as well if we have 5,000 in our retail broker as well. And we certainly cannot execute trades on behalf of our customers, because we are customers ourselves. So these three approaches go out of the window, but trend trading approach don't, because in trend trading approach we are simply making money on those huge historical price moves. Let's see what we could see as a good example in this same silver market about the trend following approach. Okay, now we have opened slightly higher time frame, and we could see that historically silver is quite interesting market because it's usually either really boring or really spiky. So now we could see, if we are going back to the history, for instance, silver went from $13 to something like $48 in what, 1.5 year. So this is opportunity for trend traders to make money, because what most trend traders do is they have idea that markets will make historical trends, but they simply don't know when and how these trends will be made. So they have top-notch risk management tool and simple approach that if something goes up, they are buying. If something goes down, they are selling. They don't know whether upwards move will go from $17 to $19 or from $17 to $49. But they know if you have this huge price swing upwards, you will make far more money than you are when losing when markets are flat. And this simple balanceation of probabilities, that if you know that most of the time markets do nothing, so you manage your losses and you have small non-existing losses all the time. But when markets move in either direction, you are making fortune. If you apply this probability across the markets, across the time frames, you might have something. And this is how historically macro traders have made fortunes, because opportunities like that happens all the time. Just look at market opportunities in stock markets, in government bonds, in forex, in commodities, in crypto in last 5 years. There are endless opportunities because there were huge market swings. So your idea is to not to forecast markets, but to understand that there is a probability that markets will make huge waves, and for you, job is to catch those waves and make a lot of money out of that. This is the way professionals work, and this is the way you could think yourself as a professional and apply that to your retail trading. So watch for my additional content about this matter, and let's see how it's possible to make money in this way, because this really works.